The choice is always between option theory and foreign currency risk management. Last diet, examiner texted option theory extensively. Number 1 question was on option. Number 6 question of number 5 question was also an option. So that's why it's okay. We have treated the concept of option. Let us look at foreign currency risk management. Between today and next week, if you can address like 70% of the topic, that is good for us. All right, I'll move to the business. What we are looking at is foreign currency management. Where a company is incorporated in Nigeria and the company operates within Nigeria, then we don't have any issue. Such company will not have any issue with currency risk management. A company incorporated in Nigeria and the company operates within Nigeria. The buying, selling, production, sales are done within Nigeria. Then such company has no business with foreign currency. However, if a company incorporated in Nigeria decide to transact business with another company outside Nigeria, then the issue of foreign currency will come to play, because there will be need to convert your local currency to the currency of the foreign partners. That implies that there must be an exchange rate at which the local currency will be converted to the foreign currency. Now, the first question is, what is exchange rate? Exchange rate can be defined as the number of units of one country currency that can purchase 1 unit of another country currency. We'll take that again, exchange rates. Exchange rates specify the quantity of one country currency that can purchase 1 unit of another country currency. For example, if I'm to buy dollar today, then I'll ask myself, how many naira do I require to buy $1? The exchange rate currently is like 1,750 naira to purchase $1. That means the exchange rate between naira and dollar. I require 1,700 naira, the quantity of one country currency that can purchase 1 unit of another country currency. That is the exchange rate. Now, these exchange rates can either be stated directly or indirectly. There are two types of exchange rate quotation. We have direct quotes and we have indirect quotes. What is direct quotes? Direct quotes. This is when the exchange rate is stated in terms of the number of units of domestic currency that can exchange for 1 unit of foreign currency. Please, it is important to understand this explanation. You cannot address foreign currency question without an understanding of the basic concept. I will take that again, direct quotation. This is the number of units of domestic currency that can purchase 1 unit of foreign currency. Like the example we gave, 1,750 naira to $1. Naira is our domestic currency. Dollar is a foreign currency. If you now say the quantity of domestic currency that can buy 1 unit of foreign currency, then the exchange rate is quoted directly. Indirect quotes. This is when the exchange rate is expressed in terms of the number of units of foreign currencies that can buy 1 unit of domestic currency. That is the opposite of direct quotes, indirect quotes. If I want to state indirect quotes, the number of units of dollars that can buy 1 unit of naira, that is indirect quotation. The relationship between direct quotes and indirect quotes is stated as a reciprocal. That is, indirect quotes is equal to 1 over direct quotes. Direct quote is equal to 1 over indirect quote. Next discussion. The rules for the buying and selling of foreign currencies. What are these rules? One is exchange rates are quoted from the viewpoint of the bank. What that means is that exchange rate will be quoted to favor the bank. Or the authorized dealer. Number 2, when the customer buys, the bank sells. And when the customer sells, the bank buys. Let me explain that number 2 rule. You must identify the buyer and the seller. When the customer is willing to buy foreign currency, then bank will sell foreign currency. Alternatively, when the customer is willing to sell foreign currency, then bank will buy foreign currency. Please note, when we say bank, we are referring to the authorized dealer. It could be an individual that is buying and selling. I can approach an individual to buy dollar. It is not a must that I must go to bank. So when we are referring to the bank, we are referring to authorized dealer. Rule number 3. In a direct quote, the bank buys at lower rates and sells at higher rates. Let us explain that. If you are giving a direct quote, if in the question you are giving a direct quotation, bank will buy at the lower rates and sell at the higher rates. Rule number 4. In an indirect quote, bank buys at higher rates and sell at lower rates. What this means is that you need to identify the type of exchange rate quotation you are giving in the question. Is it a direct quote or indirect quote? Next discussion. Terms and terminologies associated with foreign currency. One is the spot rate. The spot rate is the exchange rate for immediate foreign transaction. For example, if you are buying dollar today, or if you are buying dollar now, the exchange rate that applies between naira and dollar now is referred to as the spot exchange rate. Number 2, forward rates. This is the exchange rates of two currencies set on one day for delivery at a future specified date. The exchange rate agrees between two currencies set on a particular day, but the currency will be delivered at a future specified date. For example, if I want to buy dollar in 3 months' time, I can approach my bank to obtain a rate for the dollar I want to purchase in 3 months' time. The rate obtained today for the dollar to be purchased at a future specified date is known as the forward rate. This forward rate can be quoted at a discount or at a premium to the spot rate. The forward exchange rates are often quoted at a discount or at a premium to the spot exchange rate. where the forward rate is higher than the spot rate. Remember the spot rate, that is the exchange rate now. The forward rate, that is the future exchange rate. Where the forward rate is higher than the spot rate, this implies that the spot rate is quoted at a premium forward. The spot rate is quoted at a premium forward. Alternatively, if the forward rate is lower than the spot rate, then we say the spot rate is quoted at a discount forward. So please note, the forward rate may be at a premium or may be at a discount. Number 3, cross rates. The cross rates, this is the implied exchange rate between two currencies, A and B. The implied exchange rate between two currencies, A and B, based upon the explicit rates between the third currencies. Let me explain that. When we say cross rates, we can illustrate this. There's exchange rate between Naira and dollar. Assuming the exchange rate between Naira and dollar is 800 Naira to $1. And the exchange rate between yen and dollar, 200 yen to $1. There's a relationship between Naira and dollar. There's also a relationship between yen, Japanese yen, and dollar. But there's no relationship between Naira and yen. If you are trying to determine the exchange rate between Naira and yen, you can use the relationship between Naira to dollar and yen to dollar. That will give you the cross rate between Naira and dollar based on the relationship with cross rate between Naira and yen based on relationship with the third currency, dollar. That is the cross rate. Our next discussion, theories of exchange rate determination. The question we are trying to answer here is, how do we determine that 1,000 naira is equal to $1? Why is it that 1 naira is not equal to $1? How do we determine that 2,000 naira equals to £1? What is making naira to be weaker? What is making dollar and pounds to remain stronger? The theories of exchange rate determination. There are two major theories that explain exchange rate determination. Number one is interest rate parity theory. The interest rate parity theory. This theory states that the differences between the forward rates and the spot rates is as a result of differences in interest rates between currencies. Please, I'm going to restate that. You must be able to reproduce this in the exam. The theory of interest rate parity theory states that the differences between the forward exchange rates and the spot exchange rates is as a result of differences in interest rates between currencies. In other words, the causes of exchange rate fluctuation. In other words, the cause of exchange rate fluctuation was because of fluctuation in interest rates between countries. For example, if interest rates in one country is higher, a country with higher interest rates, according to this theory, a country with higher interest rates, we have its currency value depreciating compared to a country with lower interest rates. Look at the arguments. A country with higher interest rates, we have its currency value depreciating faster compared to a country with lower interest rates. If you look at interest rates in Nigeria, the interest rate is like 27%. Now, if you check interest rate in US or in UK, in US it's like 4. That means interest rate is higher in Nigeria.
Please, sir, I did not get that. It's like your line was breaking along the line.
Okay, I'll come back. I think you are correct. There was a break in that communication. You can mute. We are saying that, according to this theory, a country with higher interest rates, we have its currency value depreciating compared to a country with lower interest rates. For example, the interest rate in Nigeria is 27%. The interest rate in UK is 3%. Naira will be depreciating If you compare the two, 27 minus 3, that means there is 24% difference. Naira is expected to depreciate by 24% compared to pound sterling because of the differences in interest rates between the two countries. That is what this theory is trying to tell us. That it is the differences in interest rates that is causing differences in exchange rates. That is why 1 naira is not equal to $1. This theory can be used to forecast future exchange rates. The interest rate parity theory can be used to forecast future exchange rates between two currencies. We know the interest rates between the two countries, and we know the spot rates. Then we can forecast future exchange rates. With the equation below, the equation. Look at the equation, please. For direct quotes, you can use this equation to forecast 1 plus FIR divided by 1 plus DIR is equal to S over F. The first equation, if you are giving direct quotes in the question, where the exchange rate is quoted directly. The second equation will be used if you are giving indirect quotation, where IR, that is the foreign interest rate per time period. Your DIR, that is the domestic interest rates per time period. Your F, that is the forward rate, and your X is the spot rate. All right. We are done with that explanation. Number 2 theory. Purchasing power, parity theory. This theory states that exchange rates between two currencies depends on the relative inflation rates within the respective country. The exchange rate between two countries will depend on the inflation rates between the two countries. A country with higher inflation rates will have its currency value depreciating faster compared to a country with lower inflation rates. Look at that argument. A country with higher inflation rates, we have its currency value depreciating compared to a country with lower inflation rates. If you check on the internet, Look at the inflation rate in Nigeria. Compare this to the inflation rate in US. That will tell you why Naira is depreciating. In Nigeria, the inflation rate is above 30%. In US, the inflation rate is like 2.5%. Definitely, Naira will depreciate in value. The purchasing power parity theory can be used to predict future exchange rates between two currencies, provided we know the inflation rates and we are giving the spot rates. We can use the equation below. For direct codes, the equation becomes 1 plus Fi I'm sure there's like network break. Let me take that again. For direct quotation, the equation is 1 plus Fi divided by 1 plus Di is equal to X over X. For indirect quotes, the formula becomes 1 plus Fi divided by 1 plus Di is equal to F over X, where your Fi is the foreign inflation. Your Di is the domestic inflation. Your letter X, that is the spot rate. While your letter F is the forward exchange rate. No doubt, inflation will have impact on the currency value of a country. Now the question is, why is it that inflation rate is rising in Nigeria? It's not for today answer. It's for you to take home as professionals. What can we do to bring down the inflation rates? Our next discussion, foreign currency risk. What is foreign currency risk? Foreign currency risk is the risk of adverse movement in exchange rates over a given credit period. I will take that again. Foreign currency risk. This is the risk of adverse movement in exchange rates over a credit period. This risk can affect exporters. Exporters who invoice in foreign currency, and can affect importers. Importers who pay in foreign currency. If you export your product from Nigeria and you quote your invoice in foreign currency, you are exposed to foreign currency risk. That is the risk of fluctuation in exchange rate. If you import goods and you are required to pay in foreign currency, then you are exposed to exchange rate risk. Exchange rates can be very volatile. This implies that the exchange rates can move up and down by a large amount within a short period of time. This volatility in exchange rates gives rise to foreign currency risk. The volatility in exchange rates gives rise to foreign currency risk, foreign exchange risk for anyone involved in buying, selling, borrowing, and investing in foreign currency. Their foreign currency risk can be classified into three. Foreign currency risk can be classified into three. One is the transaction risk, also known as transaction exposure. Number two is translation risk or exposure. Number three is economic risk or economic exposure. What is transaction risk? What is transaction risk? Transaction risk arises in foreign transaction between two parties where the normal transaction currency of each party is different. Transaction risk happen because the normal transaction currency of the parties is not the same. If I'm transacting business with somebody in Ghana, my currency is Naira. My business partner in Ghana, his currency will be in cedis. And because the transaction also involves future receipts or future payment, transaction risk, this is the risk resulting from fluctuation in exchange rates as a result of timing difference. Please listen to that. As a result of timing difference between when a foreign transaction is entered into and when the actual settlement is done. I will take that again, please. Transaction risk. This is the risk arising from volatility in exchange rates as a result of differences in the timing between when a foreign transaction is consummated and when the actual settlement is done. For example, our company based in Nigeria we purchase or we import goods from China. Our company based in Nigeria, we import raw material from China. and we are expected to make payments in 3 months' time. The amount in US dollar, as of today, 22nd of April, we import goods from China. Let me take that again. As of today, 22nd of April, our company Nigeria, we import some goods from China, and we are requiring in 3 months' time. The amount involved is 20 million US dollar. That is future payments. Nigerian currency is Naira. We are making payments in dollar, and these payments involve future payments. The transaction was entered into today, 27th in July. We are to make payment in July. Timing difference now, because there's a timing gap. Assuming you are making the payment immediately, we know the exchange rate between Naira and dollar today. Assuming we are making the payment immediately, we know the exchange rate Naira and dollar today, but we are required to make payments in 3 months' time. We are not sure what the exchange rate will be in 3 months' time. This uncertainty creates what we call transaction risk. Translation risk or translation exposure. This risk arises in multinational companies. This risk is from multinational companies with foreign subsidiaries. The income statements and the statement of financial position will be denominated in the local currency of the subsidiaries. Let me explain that. Where you have a multinational company with foreign subsidiaries in different countries, the income statements and the balance sheet statement of the subsidiary will be denominated in the local currency of the country. At the end of the financial year, parent company of the multinational will be required to prepare a consolidated financial statement covering the activities of subsidiaries. That means the assets and liabilities of the foreign subsidiaries denominated in different currencies will be converted to the currency of the parent company. The process of converting the assets and liabilities of the foreign subsidiaries to the currency of the parent company, that can give rise to exchange loss or exchange gain. This is what we refer to as translation risk. By the time you are trying to convert, you are trying to translate liability of a foreign subsidiary to the currency of the parents. There could be risk. Then the last one is economic risk. Economic risk. Economic risk in the context of foreign exchange is the risk that a company might choose to locate its operation in a country where the currency gains in value over time against the currency of the competitors in the world market. Let me explain that. Economic risk. You can decide to locate your company in a country where the currency value is appreciating more. Like if you look at the case of some companies leaving Nigeria, we have Dunlop PSC. Dunlop PSC has moved to Ghana. PZ have relocated their operation to Ghana. They only come to do sales in Nigeria. These companies are moving to Ghana because cedis is stronger in value compared to Naira. It is cheaper to operate company in Ghana. Production cost is cheaper. Operational cost in Nigeria is higher. It is much cheaper to produce these goods in Ghana than producing in Nigeria because the currency value is weaker here. Economic risk can affect the international competitiveness of a company within a country. What we are saying is that it can reduce the ability of a company to compete at the international market. Now, cannot compete favorably with companies, with other companies at the international markets. Economic risk can affect the present value of future cash flows from foreign transactions. The economic risk can affect the present value of future cash flows from foreign transactions. This risk can reduce remittances. It can reduce the remittance from foreign subsidiary to the parent company where there's economic risk. Multinational companies risk. Multinational companies are highly exposed to economic risk. If you locate your, imagine Shell Petroleum. Imagine Mobil Petroleum. Shell Petroleum has their parent company in US. They now have a subsidiary in Nigeria. That means Shell Petroleum has placed investment in Nigeria. At the end of the financial year, the Nigerian company will be expected to make remittance to the parent company in US. Now, because converting naira to dollar and remitting to US does not make any business sense. That means economic risk can affect remittances from foreign subsidiaries to the parent company. Please note this explanation. You are likely to ask this thing in your exam. Our hedging exposure against exposure to foreign currency risk. What we are trying to discuss now is how do companies protect ourselves against foreign currency risk? There could be enormous from international businesses. You can make a lot of profit by engaging, okay? Let's go on with the class. From international businesses. However, there are risks in when you transact your business outside Nigeria. Now the question is, how do we protect ourselves against foreign currency exposure, against exchange rate fluctuation? What can we do? What are the measures? Basically, there are two categories of measures. Measure that could be taken. We have the internal measures and the external measures. Internal measures, also known as non-financial measures. It's a particular diet. Examiner says, explain the non-financial measures to protect a company against exchange rate fluctuation. So you have non-financial measures, then you have the external measures. The external measures are the financial measures. Let's go to this quickly. Under the internal measures, we have leading and lagging. You have leading and lagging. Leading simply means making payments early, before the end of the credit period. Leading means making the credit period. Lagging means making payment later, delaying payments to a later period. You can use leading or lagging to hedge against exchange rate fluctuation. The purpose of leading in a currency that is expected to rise in value. If I make payments in dollars and I'm giving 3 months grace to make my payments, and dollar will rise at a future period. Look at it, look at the illustration. I want to make payment in dollars, and I'm giving 3 month grace period to make this payment. And I got information that dollar is likely to rise in value at future period. Lead. I can make my payments early now. When you're talking of lagging, that's possible in currency that is expected to fall in value. To make payment within 3 months, and I'm aware it will fall for like 3 months, dollar is likely to fall. I will not delay the payments. So that if I'm buying dollar, I'm going to buy dollar at a cheaper rate. That is lagging. The problem with this method is the ability to predict the movement of the exchange rates. Number 2 method, you can do netting. When a company expects to have future cash receipts, if you are expecting inflows at future period in a particular foreign currency, at the same time, you want to make payment at future periods, there's some small break in line. Let me explain this again. If you are expected to make payments in foreign currency, at the same time, you are expecting inflows in foreign currency, you can simply use your expected inflows to net off your expected foreign payment. The extent to which your expected foreign receipts match your expected foreign payment, that will reduce your to foreign currency risk. That is netting off. You can do net off. Meaning, at some point, you are going to be making payment. At some point, you are going to be getting receipts. You are making payment in foreign currency, you are getting receipt in foreign currency. You can do net off. Number 3, invoice in home currency. The easiest way to avoid currency risk is to invoice your receipts in currency. You can quote your in domestic currency. You can also you can insist that your foreign customer that you want to pay in your local currency. If I'm buying goods from China, I can tell my supplier, my China supplier, that me a bill in Naira. Do not give me this bill in dollar. Once the supplier agrees to give you your bill in Naira, then you have avoided exchange rate risk. Number 4, do nothing. That company in an international buying and selling does not take any action to hedge foreign currency exposure or risk. A company can decide to do nothing. You can decide not to protect yourself against foreign currency. A company involved in international business can decide not to hedge currency risk. At some point, it is believed that for some transactions, you are going to have exchange gain, while for some, you are going to have exchange. It is believed that some foreign transactions will result in exchange gain, while some will result in exchange loss. And now use the exchange gain to cancel out the exchange loss. So there is no point hedging. Lastly, we have matching. Under internal measures, we have matching. Matching is closely similar to netting. Matching is closely similar to netting. Reduce or eliminate its exposure to foreign currency risk. It can reduce or eliminate its exposure to foreign currency risk and payments in the same currency. Network is back. I will take that again. Matching. A company can reduce or eliminate its foreign currency exposure by matching its payments in the same currency. By matching the payments, the timing of your foreign receipts, you can reduce your exposure to foreign currency risk. But note, the currency must be in the same denominator. That means we are looking at dollar to dollar, pounds to pounds. You can only match currency that have the same currencies. It's only the unmatched portion that we are now going to protect ourselves against. An extension of matching is to set up a foreign currency bank account. You can decide to maintain an account in foreign currency. So when you get your foreign receipts, you put it in dollar. It will be in your account. You don't need to convert it to naira. When you want to make payments, go to the account and make payments in dollars. We are done with the explanation on measures. We now come to external measures. Remember the external measures. Forward exchange contract. Number one is the forward market. We also call it contract. The forward exchange contract parties to buy or sell a contract between two parties to buy or sell a specified quantity. So with this,
Please mute. Tintin, mute. Oh.
Tin, please can you mute?
Oh, sorry, sir.
A forward exchange contract is an agreement between two parties to buy, sell a specified amount of foreign currency at a fixed exchange rate. The fixed exchange rate is called forward rate. But the currency will be delivered at a future specified date. That is the contract. Let us expand this, because this will involve calculation. What contract entered into now, but the settlements at an agreed future date. The forward contract is entered into now, but the performance of the contract will happen a specified future date. For example, I want to make payment in dollars in 3 months' time. I can approach a bank to enter into forward contracts. That forward contract is going to give me a rate. The bank will give me a rate today for the payment to be made in 3 months' time. I can determine the Naira equivalent of my foreign payments in 3 months' time. As of today, I can determine the Naira amount for the payment I'm going to make in 3 months' time. That means uncertainty associated with exchange rate fluctuation has been removed. Regardless of the spot rate in 3 months' time, we are going to use the forward rate agreed today. Number 2, money market hedge. As an alternative to hedge against currency exposure. As an alternative to forward contracts, we can use money market hedging. Under money market hedging, a company can create a hedge. Under money market hedging, a company can create a hedge by borrowing or lending on short-term basis in the international markets. You can borrow or lend as the international market. with an objective to fix the exchange rates now for future foreign transaction. The purpose of borrowing or lending is to fix the exchange rates now for future foreign transaction. We have to explanation here. Normally, that is my approach to hedging. After explaining market, money market hedging, good to put question to it before we go to the remaining three: currency futures hedging, current swap. It is good to put question to the first two. Get used to the two. Then we can now round up with the last three. So we are going to stop the explanation. Any questions so far? While we are waiting for questions, please go and check. Please go check your soft copy material, page 183, illustration 6, Kingston PSC. We are starting with that question first. Oh, okay. God will protect us. It's about to rain in my area.
It's heavy, yeah.
The blessing is about to come in.
Very heavy, right?
Yeah, okay, your area too.
It's already very, very heavy, yeah.
What is my area now? Girawo, Road side. It's just about to start. All right. May God bless us with the rain. May God give us blessing. So if there's no question, please go to page 183. I think illustration 6. PSC. Yeah, let's start with this question. If time permits, I want to treat 2 questions tonight. You are Kingston PSC. Let us confirm that we have opened the question so that the class is silent.
We have opened it.
All right. Kingston PSC, in brackets KP, is a Nigerian company based in Aba. KP exports finished products to and imports raw material from a country in Central Africa with currency of central dollar. KP has the following expected transaction. 1 month expected receipts, $4.8 million. 1 month expected payments, $2.8 million. 3 month expected receipts, $6 million central dollars. Next. You have collected the following information. Central dollar per 1 naira. Spot rate is given. 1 month forward rate is given. 3 month forward rate is given. Money market rate for KP. You are given the deposit rates in Nigeria and Central Africa, and you are given the borrowing rates in Nigeria and Central Africa. Requirements A. For 5 marks, discuss the significance to a multinational company of economic exposure. 5 marks. What the examiner is asking you is, what is the significance of economic risk to a multinational company? Why should multinational companies focus on economic risk? We have explained this. Economic risk can affect multinational companies. It can reduce remittances from to the multinational. It can also affect the international competitiveness of a company. It can also affect the present value of the returns to the multinational. Now look at the response, please. For requirements A, look at the response. I'm sharing this with you. Please and please try to read this and possibly understand or memorize. Don't be surprised when you see this in your exam. It is frequently being texted. The significance to a multinational of economic risk or economic exposure. I've shared what you are expected to rise. Look at it, please. Economic exposure is the risk that the present value of a company's future cash flow might be reduced by unexpected adverse exchange rate movements. Economic exposure includes transaction exposure, the risk of adverse exchange rate movements occurring in the course of normal international trading transactions. Implications of economic exposure. Look at it. Effects on international competitiveness, effect on remittances, effect on accounts, effect on operations and financing. Please, guys, try to understand these concepts. We move to requirements B. Requirement B says Explain how inflation rates can be used to forecast exchange rates. Look at requirement B. How can we use inflation rates to forecast exchange rates between currencies? What is being tested here is the purchasing power parity theory. You can use, so if you are trying to explain this, we are going to talk about the purchasing power parity. You can use inflation rates to predict your exchange rates. The theory states that a country with higher inflation rates yes, is the rain, but without God, the effect is not much. Let me copy the solution for you. Yeah, look at the solution here. So to requirement B, I'll place it. Look at it, please. You can always refer to it. This is B now. Now let's move to requirement C. This is just 1 minute. It's 1 month. And in 3 months, using the forward market. Let's go to this. Now, please note, if you are faced with question on hedging, currency hedging, I always advise students, start with the analysis of the question. It is good to start with your analysis. The network is back again. So as I was trying to explain, this company is based in Nigeria. Therefore, Nigerian currency is the domestic currency. Naira becomes our domestic currency. We have transactions in Central Africa. The currency is central dollar. Therefore, central dollar is the foreign currency. This is the foreign currency. Now look at the exchange rate information you are given in the question. The exchange rate, the exchange rate information. Exchange rate information. Examiner say central dollar per 1 naira. Please, guys, what is this type of quotation?
Indirect.
It is indirect. This looks indirect here.
It's an indirect code. Foreign currency per 1 domestic currency. This is an indirect code. Please, you must first identify the type of code you are giving. In this particular question, we are giving indirect quote. We now have the spot rates 1.7818 to 1.7822. Examiner will always give you two rates. Exchange rates are quoted in pairs. One is the buying rates, one is the selling rates. You are giving 1 month forward rates. Today, oh, we don't have control over the rain, but the business must go on. Yes. Now let's continue. You are giving 1 month forward rate, 1.7826 to 1.78. $832. You also have 3 months forward rates. 3 months forward. $1.78. What is the figure they say? Let me go and check. $4.2 to 1.7850. 4.2 to 1.7850. We are giving the exchange information. We have identified the types of quotes. This is an indirect quote. We now want to hedge. We have what we call the first strategy we are using. Forward markets. We have two transactions. We have 1 month transaction. One month transaction. 1 month expected receipts. Under 1 month, we have expected receipts 1 month. What is the value, please? Hello, guys. That is
4.8 million.
central dollar 4 million. Some students have been knocked out, but we have to continue the class. So you have 1 month expected receipt, 4.8 million. 1 month expected payments. Expected payments. This is equal to central dollar 2.8 million. Now look at it, please. This company is expecting receipts 4.8, and it's also going to make payments in 1 month's time. Both transactions are in the same currency. Then you are going to net off receipts minus payments. We now have expected net receipts. That will give us central dollar 2 million naira. It is these $2 million that we are going to hedge, where you have two transactions in the same currency and the same future time period. You are going to do a net off. It is the balance that you are now going to hedge. Now this balance, 2 million central dollar, we now want to hedge using forward markets. Once you hedge, your forward market is your forward exchange rate. Once you hedge with forward market, that means you are going to obtain a rate now for the receipt you are expecting in 1 month time. The rate obtained now is called the forward rate for transaction that will happen at a future period. Once the rate is agreed, that rate becomes the binding exchange rate for transaction that will happen in 1 month's time. The rate becomes the binding exchange rate. That means that regardless of the spot rate in 1 month's time, the rates that we have agreed today will be used for that particular transaction. Now look at it. We have gotten the net amount. Definitely you cannot use spot rates. You are going to use 1 month forward rates for this transaction. The rate is between 1.7826 or 1.7832. One is low, one is high. Now the question is, which one are you going to select for this transaction that will happen in 1 month's time? Are you going to pick the low rates or are you going to pick the higher rates? To answer this question, you need to identify the buyer and the seller. To answer this question, you need to identify the buyer and the seller. Now let's go to this identification. Our company based in Nigeria. Please listen, guys. Our company based in Nigeria. We are expecting 2 million central dollar in 1 month's time. That means when we get the dollar, by the time we receive the dollar amount, we are going to approach our bank. We are going to sell dollar to bank. Bank will give us naira in exchange. That means the customer is the seller now. The customer is KP. KP will sell, bank will buy. Got it? KP will sell, bank will buy. So at what rate will the bank buy? Under indirect quotes. Remember the rules. At what rate will the bank buy? Let me take you to the rule again. Let me take you to that rule again. Because once you understand it now, there won't be much problem again. I'm going back to the rules again. Let's go back to that rule again. Look at the rule, please. When the customer buys, the bank says. When the customer says, the bank buys. Now the customer is selling, bank will buy. Now look at it. In an indirect quote, the bank buys at higher rates and sell at lower rates. In this particular situation, the bank will buy at the higher rate now. The bank is the buyer now. Because we are giving indirect quote in this question. That means the bank will buy 1 month forward. Look at the higher one, 1.7832. That is the applicable rate now. Now come here. Applicable 1 month forward rate is 1.7832. Is back. Okay, we are back. Look at this. We are trying to make a comment here. Yeah, look at the comments. This is the binding exchange rate for the 1 month expected receipt. 1 month expected net receipts. So we now need to convert the $2 million to Naira. Therefore, look at it. Therefore, expected Naira receipts is now. You want to convert foreign currency to your own domestic currency at an exchange rate that you are giving. The next question to be answered is, are you going to multiply or are you going to divide? It is either you multiply or you are going to divide. Please note, if you are giving indirect quote and you want to convert foreign currency to domestic currency, then you are going to divide. Like this case we have here. Look at it, please. The amount is $2 million central dollar divided by 1.7832. The applicable forward rate. Please, when you divide, that will give you the Naira equivalent expected in 1 month. What is our answer, please? 1 million, 121, yes.
579.
What do you say? 5 what?
79.
5,
1579.
Thank you. This is the Naira to be expected in 1 month's time. And this Naira amount is guaranteed. Once you hedge, that hedging is binding. You are done with 1 month. You now go to, we have 2 transactions. Examiner say, calculate expected Naira receipt in 1 month and in 3 months. You now pick your 3-month transaction using forward market. 3 months transaction. For that 3 months, we only have one transaction. We have expected receipts in central dollar. This is equal to C dollar 6 million. Again, this is a receipt. Our company based in Nigeria, we are expecting $6 million in 3 months' time. When we get the dollar, we are going to approach our bank. We are going to sell, the bank we buy. That means KP, we sell. Bank, we buy. Under indirect quote, bank we buy at the higher rate. Go and look at the rate you are giving. We now come to 3-month forward rate. The higher rate is 1.7850. Bank we buy at the higher rate, 1.7850. You now come here and say, applicable three-month forward rate is 1.7850. Therefore, expected Naira receipt is, pick the dollar amount, C dollar 6 million divided by, because it's indirect code, 1.7850. That will give you the Naira to be expected in 3 months. Please compute 3 million, 361, 345. I hope I'm correct.
Yes.
Yeah, because we solved the question for physical class today. So
No,
this is the
we're not in your
expected
physical
Naira
class.
receipt. What do you say?
No. I said we're not in your physical class.
So I have to solve it. That's why we are solving it for the online class too.
Okay.
You are done with requirement C. If there's no question, we move to requirement G.
Hello, sir.
Yes, ma'am.
Please, since it's 3 months, are we not going to prorate?
Prorate what? All right, let's continue. Next, there's a question before the network glitch. Somebody asked that, are we not going to prorate because it's 3 months? And my question is, what do you want to prorate now? The examiner gave you 3-month rates. He didn't say 1-year rates. Look at this. 1 month forward rates. Examiner didn't say 1-year forward rates. Examiner said 3-month forward rate. What are you prorating? Please, let's be careful. For this part of the question, there's nothing to be prorated or to be prorated. So by extension, please do not bring in any assumption unless the assumption is in the question. Calculate the expected Naira receipt in 3 months using money market hedge and recommend whether a forward market hedge or money market hedge should be used. Now, this question is about money market hedging, and we are using it for 3-month transaction. The expected Naira receipt in 3 months. That means the money market hedge is to be used specifically for the expected receipt in 3 months. Please, we are going to go to this together. For money market hedging, you can either borrow or lend at the international money market with an objective to fix your exchange rate for future foreign transactions. I will take that again. For money market hedging, it is either the company is borrowing or the company is lending with an objective to fix the exchange rate for future foreign transactions. Look at the case here, money market hedging. Money market hedge. Our future transaction is expected receipts in 3 months. We are expecting central dollar, 6 million Naira. We are expecting an inflow in foreign currency. Our company based in Nigeria, we are expecting an inflow in foreign currency in 3 months' time. We now go to step 1. This amount, this transaction to my company in Nigeria, it represents foreign assets. I'm expecting $6 million in 3 months' time. To me, that is a foreign asset. If I want to hedge with money market, I'm going to create an equivalent foreign liability. You know the choice is between borrowing and lending. For me to hedge, because I'm expecting $6 million foreign receipts to me as a company, that is an asset to me. That is a foreign asset. So my step one, you are going to state for this particular question, create an equivalent foreign liability, i.e., the company should borrow an amount in central dollar. Now, full stop. The amount borrowed plus the interest payable must equal to 6 million central dollar in 3 months. This is your step number one. You are going to state this fact to the examiner. You are going to state this fact to the examiner. When you are done, go to step 2. Calculate the amount to be borrowed. Now, that will now take you to what is the borrowing rate in Central Africa country. Let's go back to the question. Yeah, we are here. Look at it. Borrowing rate in Central Africa, 15%. These rates are quoted annual. Annual borrowing rate in Central Africa is 15%. Examiner will always give you the rates, annual borrowing rate. But for this particular question, the transaction is for 3 months. So you are going to determine 3-month borrowing rate. This is where you need to prorate. Now come here, step 2. Calculate 3 months borrowing rates in central dollar. This becomes 3/12 multiplied by 15%. If you compute that, you are going to get 3.75%. That is the 3-month borrowing rate. Next, calculate the amount to be borrowed. Amount to be borrowed is equal to the target amount. What we are trying to target in 3 months is 6 million. The target amount divided by 1 plus 3-month borrowing rate, 0.0375. This will give you the amount to borrow. This will give you the amount to be borrowed now. If you work that out, that will give you central dollar 5 million. 5 million what? I think 783,133. Please, Emily, confirm.
It's correct.
That is the amount we are going to borrow now. By the time you get to 3 months, this amount plus the interest payable must give us 6 million. You are done with step 2. Now go to step 3. Convert the amount borrowed to your local currency, in brackets, Naira.
Hello, sir.
Yes, please.
This
Using, I can
the 1 plus 0.375. I don't understand.
You want to borrow an amount now. The amount you are going to borrow now must give you 6 million in 3 months' time. The amount you borrow now plus the interest you paid on your borrowing should give you 6 million in 3 months' time. That means the 6 million is the future value. That's 6 million is your future value. You now want to get the present value of 6 million. You are not going to discount to present value. The discounting rate is 3.75. Now, do discounting. Discount 6 million at a rate of 3.75. What is the present value now? What we have done here is calculating present value of 6 million in 3 months. That's what we have done. To do this, the future value divided by 1 plus R. Your R is 3-month borrowing rates. Is that better, please?
Yes, sir. Thank you.
Now, when you get to step 3, you are going to assume that the company has borrowed the money. You know, the company borrow is in dollars. You now convert this to your own local currency. The company will borrow immediately. You don't need to wait for 3 months. You borrow immediately. That means if you are borrowing the money immediately, if you want to convert, you have gotten the cash. You are going to convert using the spot rate. Spot rate is for immediate transaction. Now look at the spot rates. You have the low rates and you have the higher rates. Which of the rates are you going to use? Assuming we have borrowed the money, that means we have the cash with us. KP has borrowed the money. KP has the cash with him. KP will now go to the bank. KP will sell. Bank will buy. That means the applicable spot rate is higher rate, 1.7822. This is the rate you are going to use to convert this. The Naira amount, Naira equivalent is Central dollar 5,783,138 divided by 1.7822. Please compute the Naira equivalent. That should give us 3 million.
Yeah, 3,244,940.
I think 3,244,000 something.
244,940.
Yeah, 3,244,941 approximately. That is the Naira equivalent that our company will receive now. Then the last step. The last step, step 4. Step 4. The Naira equivalent will be invested for 3 months in Nigeria. Invest the Naira equivalent in Nigeria money markets for 3 months. Now go check the question. What is the deposit rate in Nigeria?
9%.
That is 9%. That 9% is annual deposit rate. But you want to deposit for 3 months. So first calculate 3-month deposit rate. 3 months deposit rate in Nigeria. This is equal to 3/12 multiplied by 9%. That will give you 2.25. So ask yourself, if you deposit 3,244,941 for 3 months at this rate, how much are you going to expect at the end of 3 months? Expected Naira receipts at the end of 3 months. You are going to deposit an amount now at a rate of 2.5% for 3 months. Expected Naira receipt is equal to amount deposited 3,244,941 multiplied by 1 plus the deposit rate, 3-month deposit rate, 0.0225. Please compute what is the expected Naira amount in 3 months' time. 3,317,951.
951.
Yes, please.
3,317,951.
951.
Hello, sir.
So what? Yes, ma'am.
We are not discounting it by dividing it now. We are multiplying it. Why?
Please, we are trying to explain it. Ask yourself, why do we multiply? Place yourself in this shoe. You are depositing money now for 3 months. Imagine you have deposited 3 million now at a rate of 2.25%. How much are you going to expect in 3 months? That becomes future value. You know the present value now. You now want to get future value. The first one we divided because we know future value. We now want to get present value. The second one we multiply because we know the present value. The present value now is we have 3,244,941. We now want to invest this money for 3 months. We now want to get what is the future value to be expected in 3 months. If you remember, that's why if you look at mathematics of finance, future value is calculated at present value bracket 1 plus, look at the formula for future value. Look at the formula. Look at it. If you want under simple interest, compound interest, future value is equal to present value bracket 1 plus R. If you look at it, if you want to get present value, make present value the equation. Present value is equal to future value divided by 1 plus R. This is what we have just done. This is what we have just done. Present value, the step 3, we calculated present value. The future value is 6 million. Future value over 1 plus R. Step 4, we want to know the future value. We know the present value. This is what we have just done. I hope it's better.
Very clear, sir. Thank you.
So, to round up, we are done anyway. That means if we should hedge with money markets, Naira amount expected in 3 months is 3,317,915. We can now compare it. Under forward market hedging, because we need to recommend. Look at it, summary. Under forward market hedge, the Naira amount is 3,361,345. If you hedge with money market hedge, the Naira amount is 3,317,951. Which one will give us the higher Naira receipts? Which one is better for us?
You forward.
Recommendation. KP should hedge the 3-month transaction, using forward market hedging. because it gives the company higher naira receipt in 3 months. You are done with the question. We are done with the question. The E part is limitation of currency futures contracts. We are going to explain it in our next class. You know, we have not discussed currency futures contracts. We only discussed the first two: forward exchange contracts, money market hedging. So we are going to stop the class here. We can't take 2 questions tonight.
I have a question. I have a
Sorry,
question.
Nota, you have a question?
Yes.
Yeah.
This step 2, this step 2 under the money market hedge. Okay, the company had to borrow the Central Africa dollar. So if the company is in Nigeria, how do they carry out that borrowing? Will they borrow it in that other country? Because the rate we used for that borrowing was the interest rate in that country to borrow the 6 million. So of course we now discounted the cost and now got that 5.7 million. So I'm just wondering the process of this hedge, how they borrow the money. You go to the country, do they borrow it in the country, or because we use the interest rates obtainable in that country? Or is it a Nigerian bank that will provide the foreign currency for them to borrow as part of the hedge? You know, so I'm just curious about
The
how.
lecture is out now.
Oh, it's out. It's still there. Okay, so we have closed now.
You are expecting $6 million in 3 months. And now you want to borrow against the 6 million you are expecting. Bank understand what you are trying to do.
Yes, I want to know, where do they borrow it from? Because the company is in Nigeria. Do you borrow it from a Nigerian
That's
bank,
what I'm
or
saying.
yes?
So you are going to have your own banker, Abi?
Yeah.
You can approach your first bank to explain to them that my customer in Ghana will pay me $6 million in 3 months' time. So I want to hedge against that money. I want to use money market to hedge. Please, I want to obtain a loan in dollars against the 6 million I'm expecting. Your bank will now confirm that payment, that the customer will actually pay you $6 million in 6 months, in 3 months' time. Your bank will now say, okay, now how much do you want to borrow? That, look, I want to borrow an amount now, plus the interest I will pay. Both of them must equal to the money I'm expecting in 6 months, in 3 months' time. Your bank will now give you the interest rates for 3 months. They will now determine how much you can borrow now against the payments, against your receipt that is coming in 3 months' time. Once everything is confirmed, Bank will give you the money. Say, go, no problem. In 3 months' time, by the time you receive the money will still come to the bank directly. No, there's going to be, we call it corresponding banking. The corresponding banking and do international transactions. By the time the customer wants to pay you, it won't bring cash to your country in Nigeria. It will just send the money to your own banker in dollars. Your banker will now ask you, do you want to convert it to Naira or not? Because you have borrowed, you don't need to convert now. As soon as your customer pays you in 3 months, the money will enter your account. The loan is also in your account. So as the money is entering your account, it will just cancel out the loan and the interest. Is that clear? Is that clear, please?